In today's video, I want to touch on 5 quality companies that are trading near their lowest valuations ever. Yes, we're talking about 5, usually 4, but inflation. Joke of the day, we got that out of the way, great. Anyways, without wasting too much of your time, these are the companies we're going to touch on today. Yes, these are known companies, not small ones either, but quality names. I hope you keep watching, and if not, at least leave me a like and a comment, would really appreciate that. And of course, if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Make sure to check out the FinChat link down in the description to get 15% off. More on them a little later in this video. So company number 1 I want to touch on is Amazon. We did a specific Amazon video on Friday, so I'm going to speed run through this part. Market cap just over $2 trillion. Performance-wise, in the last 5 years, it's up 106%. Year to date, down 10.7%. In the last 12 months, up 10.4%. Looking at valuation, trailing 12 months PE, 35.3 times. Forward PE, 30.8 times. Now, if we look at EV to EBIT, we can see that it's now just under 31, and that's the lowest it has been, well, since 2016, so since a long time. Looking at forward EV to EBITDA, that sits at 12.58, also lower than the 6-7 year median here of just under 20. Now, of course, with Amazon, seeing the size of this business, don't expect revenue to explode, right? Don't expect 20% year-over-year growth. But what you can expect is that this business is becoming more and more profitable. If you look at free cash flow, very important metric, free cash flow is expected to grow by 53.5% in fiscal year 25, and then another close to 45% in the next 2 fiscal years to reach $108.9 billion in fiscal 2027. So basically a doubling of free cash flow, more than a doubling actually, in the next 3 fiscal years. Looking at the overall business, gross profit margin since 2018 has gone from 40.2% to 48.9%. Free cash flow margin did drop. I mean, it's been negative actually in 2021, 2022. We're now back above 5%. I do expect that to continue to go up slightly in the next coming fiscal years. Now, Amazon, as you know, it has plenty of businesses, right? It's one of those businesses where you can expand, or they have expanded their total addressable market. We can clearly see this right here. Yes, online stores, still the largest chunk. Then you've got third-party seller services, and now Amazon Web Services, above $100 billion yearly. Now, that business is an extremely profitable one. If you look at the bottom here, June 2023, 25% operating margin for AWS. We're now at 37%, and that's why you're seeing the dollar base becoming bigger and bigger, and that jump since you're expanding margin. Look at this jump right here from 23 to 2024. Quite something. And of course, like I said in the past video, these are the fast growing segments and the segments that have higher margins. This is also excluding AWS. So we've got subscription services since 2014 that has grown at a compound annual growth rate of 32%. Advertising since 2019 grown at a compound annual growth rate of 34.8%. Third-party seller services since 2014 has grown at a CAGR of close to 30%. So with Amazon, it's truly one of the best businesses ever created and one of the best businesses to own in one's portfolio. Moving on to company number 2, and that's Uber. Now, Uber has a market cap of $158.4 billion. In the last 5 years, the stock is up 238%. In the last 3 years, it's up 127.5%. The last 12 months, it's down 5.4%, but year to date, the stock is up 20.1%. So definitely outperforming the market. Now, all of this you can find on finchat.io, proud new sponsor of some of the videos on the channel. Now, if you don't know what FinChat is, it is a stock research platform that has complete financial data on all stocks globally. And the best part is this one. This part is the best part of this platform. This is what you're seeing in each of my videos, is that it tracks company specific data points. For example, with Uber, you go to the KPIs here and you want to look at mobility revenue. You want to look at the delivery revenue and freight revenue. You can click all of those and you get these quarterly figures very nicely here on the chart. Maybe even if you want just to look at the revenue percent change, which was what we're getting here for freight, you can get that as well. You can even reorganize all of it for it to look much nicer. You can do that with a lot of metrics here. You can look at revenue per geography, adjusted EBITDA, and then of course some other KPIs, some monthly active platform customers, for example, total trips, and more. So if you want to try it out, all new users will get 2 weeks for free of FinChat Pro. And if you want to upgrade, you can use my link down in the description to get 15% off. You help yourself out and you help myself as well. Would really appreciate that. Continuing here with Uber, you can see that EV to operating cash flow is also close to the lowest level it has ever been for the company. As we've seen with forward PE, also quite low compared to, well, the historical numbers that we've got. I mean, previously, of course, Uber was very expensive. Uber was losing quite a lot of money. Right now, the average analyst price target sits 17% higher than the price we're at today. But this is a company that's expected to become more free cash flow positive in the future. So free cash flow is expected to grow close to 17% in fiscal 25, 24.5% in fiscal 26, and then close to 18% in fiscal 2027. All in all, this is basically the story. It's a free cash flow growth story. Free cash flow margin went from negative 37.8% in 2019 to now 15.7% and growing. If we look at total trips and monthly active platform customers, those are the KPIs that you can find on FinChat. Here as well, after the pandemic, after the lockdowns, a nice and solid rebound for both of those metrics. Now, here you can clearly see what was the issue previously. Previously, CapEx was actually higher, much higher than where it's at right now. But look at that free cash flow burn, basically. So we flipped the switch back in 2022. And since then, it has been, well, a wonderful story to follow. Looking at total employees did increase by 15.6% since 2019, but revenue per employee increased 170.4%. Of course, I like Uber. I own it. I've been an owner since late 2024. One of those contrarian positions I took going into 2025 because there was just too much pessimism around the company because of, well, autonomous vehicles. I still think as of today that Uber is very well positioned for the future. So very happy shareholder. Moving on to the next company, also shareholder of that, although much, much smaller position in the core portfolio, and that's Airbnb. It has a market cap of just over $80 billion. Now, Airbnb, since it went public, actually, it's down 11%. In the last 3 years, it's down 20.4%, and year to date, it's down 2%. Now, why is that? Is it a bad company? No, it's not a bad company. It's just a company that was mispriced when it went public. I mean, the stock was going up and up and up to around $200 or so. Of course, full on 2021 bull market bubble, whatever you want to call it. But it did bottom. It did bottom late 2022 at around $85 or so. So it's up since then. Okay, fine. Valuation wise, trailing 12 months forward PE about the same. But other than the fact that the average analyst price target sits 22.3% higher than the price we're at today, if we look at forward PE and then look at the average in the last 3.5 years or so, it is lower. The average sits at 38.5 times. We're now just under 30 times. But if you look at EV to operating cash flow, that is close to the lowest it has ever been. Of course, ever been, well, since it went public. And is Airbnb such a bad company today? I don't think so. I mean, if you look at the projected growth, revenue growth for the next coming fiscal years, it's around, let's call it 10% on average in each of those fiscal years. So definitely not the super high growth company that it was previously, but I do think that these numbers, especially in fiscal 26 and 27, will be revised on the way up. Remember, they expect to launch new businesses each year that could potentially generate them an additional $1 billion. Now, what would those businesses be? I don't know. There is a big summer event, I believe, so they'll tell us a bit more about that. I also think that Airbnb as a business, experiences did really not deliver. Let's be honest, experiences did really not deliver. And I think now with Gen AI, I think they could do much more with their app. For example, if you want to book a trip with Airbnb, you should be able to talk to a chatbot, say exactly what your budget is, what are the dates, where you want to go, how many people you are, and it should find everything you need with just one push of the button. Then they also talked about some partnerships. So let's say they partner up with an Uber Eats and all of that. Imagine you book a trip the Uber driver comes pick you up to the airport. Then from the airport to your Airbnb. Once you arrive to your Airbnb, you've already ordered your Uber Eats, all your groceries are already there, you're ready to go. Makes sense, no? Then you can add advertising on top of that and some other extra stuff. For example, a rewards program. Why does Airbnb not have a rewards program already? Doesn't make any sense. Another competitor, I would say, Bookings, for example, performance of that stock has been incredible over the last couple of years. Business-wise, great company as well, but they have a rewards program, right? Genius. I mean, Genius is one of the main reasons, I would say, why I go to Bookings, other than the fact that you can, expense stuff doesn't matter, but the fact that you get some points and then you might get some 5% off here, 5% off there, makes you want to come back. Same thing could happen with Airbnb. I think this is a missed opportunity. Continuing here on the financial stuff, if you look at, first up, let's look at this one right here. Gross profit margin did increase over the last couple of years. Free cash flow margin did increase over the last couple of years as well. Although since 2022, free cash flow margin did stay around just over 40%, which is very, very good, right? Free cash flow margin of 40%, very, very good. If you look at total employees, that did increase 19% since 2021, but revenue per employee increased much faster than that, 53%. So that's good. Moving on to the next company, and that's more in the software space, and that's Salesforce, ticker symbol CRM. Salesforce has a market cap close to $270 billion. In the last 5 years, the stock basically doubled. In the last 3 years, it's up 28.6%, and then year to date, stock is down 15.1%. Looking at the PE trading 12 months, that sits at 43.9 times, but the next 12 months sits at 25 times. So expected, it's now looking cheaper than it did before because it's becoming a little bit more profitable. And if you look at the stock performance in the trailing 12 months, it's down 8.8%. Currently, the average analyst price target sits 33% higher than the price we're at today. And here as well, if you look at forward EV to free cash flow, we are also close to the lowest level it has ever been. And if you're wondering what the forward PE average was for the last 5 years, was just over 41 times. That's of course because of that period here, that extremely bubbly bull market back in 2021. Looking at what's expected to happen in the future. So in the future, revenue growth of around 10% or so, free cash flow growing a little bit faster than that in fiscal 27 and 28, but slower in fiscal 26, only 7.5% year over year growth. Zooming out, gross profit margin has improved, has been stable, but has improved since 2019. Free cash flow margin did definitely improve. We went from 21.6% to 32.8%, and you can see that very good acceleration here since 2022. Now here, if you look at total employees, that increased by 56% since 2019, but revenue per employee only increased close to 25%. So yes, it's true that in the last 2 years, we have seen a small increase in revenue per employee. Maybe that will continue and that might justify the big increase in total employee. But as we've seen with a Salesforce, for example, it was a bloated company. That's why we've seen this layoff here. We'll see what happens in the future. Definitely a very, very good company, very profitable company as well. Moving on to the last company, and that's one that's been under fire. So that's Adobe. Adobe has a market cap of just under $170 billion. In the last 5 years, the stock is only up 26%. In the last 3 years, it's down 14.5%. In the last 12 months, 24.2%. And year to date, it's down 12.1%. Valuation-wise, PE, 25.2 times trading 12 months, forward 18.6 times. Currently, the average analyst price target sits 35% higher than the price we're at today. If we look here at EV to EBIT, it's also one of the lowest point it has ever been. So there is that. Maybe Adobe has peaked, although as you will see, I don't think that is the case just yet. For future growth, free cash flow growth is expected to decelerate in the coming fiscal years. Fiscal 25 still expected to see 17.9% year-over-year growth, followed by something like 10%, and then just 6.8% year-over-year growth in fiscal 2026. If we look at digital media ARR, we can see that, it did peak. Year-over-year growth here did peak in December 2023, although that was a comparison towards a very, very low base here. So the fact that right now we've seen it actually tick up a little bit, could be a good sign. All in all, gross profit margin has stayed around 85-86% or so. Free cash flow margin has been picking up a little bit here. I'll show you in just a second what has happened in the last couple of quarters. All in all, the business itself is still growing and doing okay. It's definitely not a high growth stock, but it's a compounding company. It's a company that is growing steadily and returning value to shareholders. Now, if we look at the last couple of quarters, we previously seen yearly, but what about quarterly? Well, previously you can see that free cash flow margin was around 40-43% or so. Like I said, gross profit margin has basically stayed the same. But then there was a period, of course, that period was also because of that Figma acquisition. They had to pay a fine because that acquisition did not go through. So you take a hit because of that. But in the last couple of quarters, it has come back to the same level that we've seen, or around the same level that we've seen since Q4 2022. So even with all the negativity, the noise around Adobe, generative AI could destroy it, etc., it's still a business that is doing quite well. Here, if you look at total employee, that increased 35.6%, but revenue per employee increased a little bit faster than that, 39.6%. Now, like I said in my previous Adobe video, it's their game to lose, right? They've got the full suite of products, they've got all of their subscribers, they've got the ecosystem. I do also think that they've got the pricing power. It's their game to lose. They need to innovate faster, they need to release products faster than before. Because if they have all of it, if they have the image generator, text to video, video editing, you name it, all of that can be done in the Adobe ecosystem. If you see other smaller startups come up with newer models or new ways of designing or whatnot, you should innovate faster and you should make sure that you're releasing those products faster as well, because you have that ecosystem, you have that distribution network as well, because you have all of those subscribers. Plus, they have a big advantage over all the rest. Whatever you do with Adobe, most of it is licensed content. So if you are a marketing agency, you know that if you're using Adobe, you are unlikely to steal assets that are not licensed, and that's a big plus. So with Adobe, I think it's their game to lose. What do you think about all the 5 names? Do you own some of them? Have you sold them? Are you looking at them? Let me know down in the comment section below. Hit all the buttons, would really appreciate that. Check out FinChat down in the description and the pinned comment to get 15% off. And I'll see you all in the next one. Bye bye.